From SBI's Executive Briefing Center in Dallas, Texas, the most watched and listened to content in B2B sales and marketing, it's the SBI Podcast.
Welcome to SBI TV, a weekly show dedicated to helping you make your number. I'm Mike Hoffman, Senior Managing Director of Private Equity and Financial Markets at SBI. Today we're going to talk about revenue growth challenges that most SaaS companies struggle with as they try to scale. In the studio today, we have a seasoned expert on the topic, Pablo Dominguez. He is an operating partner at Insight Partners, a leading global software investor with 25 years of experience operating and investing in the sector. Pablo, welcome to the show.
Thanks, Mike.
Before we jump in, I think it'd be great to share a little bit about your background, types of companies you work with. So why don't I turn it over to you?
Cool, thanks. So I've had the pleasure of working in the Salesforce effectiveness space for the last 21 years. I've done everything from management consulting. I've worked in public companies and also private companies. A lot of experience running operations teams and also running sales teams. So really love the space of go-to-market and working with our portfolio companies. And at Insight, we're a venture capital and private equity firm, so we do very small checks. We do very large acquisitions as well, so we have a good breadth of portfolio companies that we support. And we're really focused on the software space and scale up, right? So not necessarily startups that are just kicking off, but really helping companies take that next turn of evolution on their journey.
Good, thanks. You know, it reminds me of the conversation that we were having backstage when you talk about the companies as they're scaling up. And one of the things we discussed is that, you know, as they're developing their frameworks, these SaaS scale-up companies, at times they're not necessarily prepared for the competition that's going to come down the road. They're in a fast-growing market, and they're not in a position to kind of weather that economic downturn. So to accelerate organic growth, they need three fundamentals. I think we debated and we came down to three. One was customer segmentation, the second was market coverage, and the third was sales compensation. So let's talk about segmentation. So without a clear understanding of the segments, sales and marketing resources will generally get misallocated, but I think we agreed on that.
Yep.
And this leads to higher selling costs, missed sales revenue goals, which you invest in growth companies, it's probably the ultimate sin. So how do you guide your portfolio companies through truly understanding their markets?
Yeah, so it's a great question, right? So when you're a startup, a customer is a customer, right? Any dollar is a good dollar, and you're just trying to get out there to close whatever opportunity you can, right? It doesn't really matter if you're segmenting. We see a lot of companies in the sort of early startup stage that don't have segmentation. When we get involved in the scale-up stage, you're really trying to help your customers understand, okay, how can I go to market more effectively, right? Am I targeting the right customers? Do I know which customers have the most potential for me as the seller, right? And I might have product A, product B, product C, and I want to understand, are all of my products the best fit for one customer, maybe only one product for another customer? So what we do is we have what we call scale-up 360s. And so we offer these within our product center of excellence, marketing center of excellence, sales, customer success. And so we go in and do a deep dive and work with our portfolio company, with the CEOs, with the CROs, CMOs, COOs, to really help them understand, what does the market look like? Where's the potential, right, from an industry perspective or a segment perspective? And which customers should you go after? And then ultimately, you know, design your organization to go after those segments.
What about accounts themselves, right? So that's the market piece of it. But B2B SaaS companies also need to understand which accounts in their market that are going to generate the most revenue. Right? What are the highest potential, and what are the highest potential over the shortest period of time, right? There are probably some investment horizons that you have. What are some of the common mistakes you see companies make when it comes to account segmentation?
Yeah, that is a great question because we see this happen a lot, right? Customers are like plants, right? So you go to the store, you want to buy some plants for your house, your apartment, et cetera. You've got a lot of choices, right? You don't just go buy a bunch of plants, come home and put them around your house and assume everything is going to work out, right? Some plants require a lot more water. They require water weekly, daily, et cetera. Some plants don't require a lot of water. You could buy a cactus, for example, right? Some plants require you to move them to the sun a little bit. So it's very similar like customers, right? So if I have a number to hit, we all have a number to hit, right, at the end of the year. And as an example, let's say I'm focusing on enterprise and mid-market, right? And my reps are only going after enterprise accounts, right? Those are going to be long sales cycle. Yes, they're going to be large deals. But if I don't balance my customers to really understand, well, what types of deals should I close on a yearly basis to hit my number, I may miss my number if I'm only swinging for the fences, right? So we try to get a good understanding from customers on which customers are going to bring you what types of revenue, in what time frame, right? Some might take 9 months, 12 months. Some might take 1 month or 45 days, 90 days, et cetera, right? And you want to have a balance of that, right? No customer is created equal. Some customers require more onboarding. They might require more post-sales activity. So you've got to make sure you've got a good customer journey between all your commercial resources, between product, between marketing, services, to make sure your customers stay with you and also continue to bring you revenue throughout the lifetime.
Helpful. So one question, and this might go back to when we had the Insight Summit, and we had a little breakout discussion with some of the portfolio companies around segmentation. I think the question came up there. How often should the portfolio company look at segmentation?
Yeah, so that's a tricky one, right? What you don't want to do is do segmentation every 3 months, right? Because it's very burdensome on the organization.
Right.
You're changing two things too much, right? But we'd recommend you looking at segmentation every single year during the planning cycle, right? And the planning cycle really should start, if you're on a calendar year, right, around May, June timeframe, because you don't want to wait until Q4 to start planning. I know that might be difficult depending on the size of the company, right? But we definitely think it's important to look at your segmentation every year to understand, hey, am I going after the right customers still? Are those customers still the most profitable to me, right? Do I need to roll out new products for certain segments because there's higher demand? Have competitors come into this space that I need to be aware of, right? So it's a yearly thing that you should look at. We have seen companies that change their segmentation every quarter. Again, it's very disruptive, but sometimes you have to adapt or die, right? So, but at a minimum, it should be looked at annually.
That's interesting. So you said, I'm just going to jump back for a minute. You said May. Most companies start thinking about annual planning, I would say August, September, but you say May.
I say May, yeah, because you've got to start thinking about your strategy earlier on, right? If you wait until Q4, one, you're going to be burdened with, I got to close Q4, right? Which is probably most companies' heaviest quarter.
Right.
Is it aspirational to start in May? Absolutely, right? But that's what we would recommend is at least start having discussions around how's our strategy going to change as a company, right? Are we going into new markets? Are we selling new products? Are we trying to be something different, right? Do we need to hire more salespeople, invest more in marketing? Do we have the right engineering resources to build the product, right? So those discussions, the earlier they start happening, the better you are as you get into Q4, so you get into Q1 successfully.
Well, I think that's great guidance because I can tell you we've seen companies before that probably didn't get their comp plans for the year out until April. Yeah. So it's a lofty goal for May. So thank you. I think that was really insightful on the segmentation side. If we could, let's talk a little bit about coverage and org design. So solid sales strategy answers two questions. Where do we play and how do we win? Segmentation answers the question of where do we play, but how you win starts with the right coverage model and org design. So what are the factors SaaS companies should consider when they're choosing an org model? So how can they align their organization, highest areas, highest opportunities within the market? Thoughts on that?
Yeah, no, absolutely. It's a great question. So you've finished your segmentation, right? You know which customers have the highest potential and might be the most profitable to you. So 3 things I would say to look at is 1, coverage, and then what the org design should look like, and then capacity, right? So with coverage, let's take an example, right? You might say, I've determined that I should break up my market into strategic accounts, let's say the Global 2000, and then everything that's not that. So we'll call that mid-market, right? Because the potential says that there's 50% of the TAM is in the larger accounts, 50% is in the lower end market. So that's one way to segment, right? From a coverage perspective. I may also determine that I need to have certain regions, right? I might have a region in EMEA, let's say, and the US and APAC and LATAM because there's significant potential there. There may not be potential in certain regions, right? So I'd say first look at the coverage in terms of how you want to split that up, right? And then from an org perspective, in terms of understanding the types of roles, you really need to think about, well, who do I need selling into the coverage model I've just built, right? Do I need one person just going after new business? Do I need one person going after new business and expansion? And depending on the size of company, right, you might not be able to afford having roles that are split up, right? You might have to live with blended roles for a little bit. So one person doing new and expansion, right? So it's really understanding how can I go after, again, that target that I have to hit for the year most effectively with the resources I have. And you determine that with sales capacity planning, right? And we call it sales capacity, but it's really commercial capacity, right? So if I have to hit a certain target, and if I have to expect a certain level of productivity per rep, right? And I have a certain sales cycle and my average selling price is X, well, how many resources do I need, right? I might need, let's say, 10 people selling new business. Okay, if I'm early stage scale up or late stage startup, I may not have a lot of customers that require hand holding yet, right? Because I haven't built up that base of customers that need support. So can I live without a customer success team, right? Or account managers and just live with a current account executive? So the model will help you understand, okay, mathematically, how many people should I have, right? But it's as much of art as a science, right? Because selling is a lot of art, right? So you want to make sure you get input also from commercial leaders on where should I have more resources, et cetera.
So it begs a little bit of a question on growth companies, SaaS growth companies. There are two ways to grow revenue. One is you add more salespeople, and two is you make the current salespeople more productive. Is there a time and place that you focus on one versus another?
Yeah, so I would say we always think of things in terms of people, process, tools, right? And I think it's very easy for companies to say, I've got a new target, I've got to grow 10 million this year in ARR, right? And I'm doing $1 million per head, so I'll just add 10 heads, right?
Right.
The question is, to your point, can I get 1.2 million out of my existing heads, right? So therefore, I don't need to add 10 heads, I can add 9, right? Or whatever the math is. It depends, right? I would say you have to do careful analysis to understand where am I adding the heads, right? Depending on the region, the vertical, the types of accounts. Again, we talked about enterprise versus mid-market. Do I have the right training and onboarding to get people ramped up quickly, right? Or to make sure that people understand how to sell my product? Do I have the right tools in place to make them more productive as well, so they're not wasting time with non-selling activities? So I'd say it's a balance of both. I don't think one solves it one way or the other.
Right, so it's a little bit of how can we get some operating leverage in sales and marketing, grow productivity, and then where do we want to invest? Because we know if we add another person, it's going to equal another $1 million in revenue. Good. How do you, on that same line, how do you identify more cost-effective routes to market that exist, right? There's a lot of analysis that goes around unit economics in the SaaS world. So how do you look at markets like channel or inside sales, and do you find situations where you want to find an alternative because early on they said it's inside sales and that's it? So how do you look at alternative routes to market?
Yeah, so great question. So there's a couple of things we look at, right? One is, and we work with a partner, Reveneer, that does outsourcing for BDR and inside sales, right? And that's one route to market that we like to recommend to a lot of our portfolio companies, right? As you're standing up a BDR team or inside sales team, is the most effective way to do it in-house or have somebody else do it managed services for you, right? They're still part of your team, they're just being managed by somebody else, right? The benefit is, one, you get more leverage, they can ramp more quickly, they're using the best technology, et cetera, right? So that's one route, right? The second is, do I need inside sales versus field sales, right? Field sales is much more expensive. There's this belief, I think, in most companies that I need somebody needs selling FaceTime to a customer to be successful. Inside sales can't sell to enterprise, right? Or it's not going to be successful. And I think we've seen that disproven, right? I think we've seen a lot of companies, industries, different sizes be very successful doing initial sales over the phone, right? Even getting to a certain point before maybe having to bring in somebody from the field. So I think that's an area where, as you evaluate your segmentation, your coverage, you can leverage different types of resources to go after the market. And then the third is channel, right? So at what point can I get more leverage by using a VAR, an SI, or an SP to go after parts of the market that I may not be able to access, right? Or that they can give me broader leverage versus adding 100 more salespeople. The biggest concern I think we see there from companies is, can I trust somebody else to sell my product, or will they pitch it as effectively as me? What we always like to tell people is, you're not the first company to leverage a channel to sell your product, right? This has been going on for years, and it definitely does give you leverage, and having the right relationships actually helps augment your sales team.
Yeah, I think that's a struggle in both of those cases. It's one, the channel, and the second is outsourcing of BDR and inside sales groups, which I agree with you. We've found it's very, very effective, and an easy way to spin it up quickly. So effectiveness, quickly, good. Anytime you make a change to coverage within a sales organization, it can be a heart transplant.
Yep.
So is there guidance on what's the right time or way to do it to minimize the disruption in the field and minimize any impact on revenue?
Yeah, so great question. So before we talked about when to look at it, right? So start early in the planning process.
Right.
What I've seen work most effectively, and again, I think it can probably work at different times throughout the fiscal year, but trying to start at the start of a new fiscal year so you're not disrupting the current selling motion. There's nothing worse for a sales rep than I've got my set of accounts, I'm excited, I'm gonna hit my quota, and then the company says, guess what, segmentation, coverage change, you're now part of a different org, we're introducing this, you're getting less credit for that, and it disrupts the flow, right? So if it can, in a perfect vacuum, starting at the beginning of the year is best. Sometimes you don't have that luxury though, right? You go through an acquisition, you buy somebody, or you augment your sales staff, or you have to go into a new region and you've got to do some changes, right? So you've got to be willing to pivot, but ideally try and limit those changes to the beginning of a fiscal year so you can kick off with, new coverage, organization, comp plans, et cetera.
And then stick with it.
And then stick with it for the year. Yeah, you gotta give it time to to marinate and actually cook and see, did it come out okay or not.
Right, and May comes soon enough when you can start planning for the following year.
Exactly.
All right, really helpful guidance on this, thank you. Pablo, I'd like to have a conversation about sales compensation. So once the right coverage plan and org design are determined, structures put into place, but compensation plans are what drives behavior and they propel the strategy forward. And I've often said, comp plans don't solve a business problem, but they certainly impact behavior. So what are key data points you look at when you help SaaS companies put together their comp plan?
Great question. So two things I would say. One is a quote from David Chicelli, who's the forefather of sales compensation. He always said, comp is the caboose, not the engine, right? So comp should not drive strategy. Strategy should drive comp. And I think a lot of companies sometimes say, well, let's change the comp plan. We want to drive this product or this. Comp is the easiest lever to pull, right? Because you can make tweaks very easily. And that's the biggest mistake we see companies see. The second point I would make, and this is something I've sort of said my entire career, is comp is not a substitute for management, right? Sometimes people say, and you look at comp plans and there's 20 measures in it, right? And it's because everybody rose their hand and said, well, we got to make sure the reps do this or do that, do that. No, that is a leader's responsibility to make sure reps do that, right? So those are the two tenets sort of we start with. When we look at sales compensation plans with our companies, right, we really want to look at the data, right? What's the historical performance for the organization at the rep level? What's causing the performance to either be good or bad? Is it the comp plan? Or could it be the product? Could it be lack of training? Could it be competitors in Arizona and the United States have come in and that's why performance is down because we're losing share, right? Or something's happening in Germany from a market perspective. So you don't really know until you dig into it, right? And so we also want to look at what's the mix of business that a rep brought in? Did they only focus on one product or a different product, right? Did they close very large deals or small deals? So you take all those factors to try and understand what really happened and why. And then you look at the comp plan to see, okay, is the comp plan driving the strategy that the CEO and the CRO set, and does it reinforce the right behaviors? And if not, how do we tweak that to ensure that reps are getting paid effectively for what the company wants them to do?
That's good input because it is normal knee-jerk when a sales strategy isn't working to say it's either the comp plan or we need to get rid of the sales leader.
Exactly.
Right? One of those two answers, so that's good insight. So depending on, different companies have a different sales cycle length. Some might be 9 months, some might be a week, some might be a day. How do you tell whether or not comp plans are incenting the right behavior? Does it take time? How do you guide companies through the process of not getting frustrated with whether or not they made the right comp decisions?
Yeah, so it definitely takes time, right? Or it doesn't. So for example, if I've got a very short selling cycle, very low ASP, if I make a change to the comp plan, I can probably see it pretty quickly, right? If I can sell a deal in 5 days, I'm on monthly quotas or quarterly quotas, any change I make, I can see in a week or 2 weeks. So it's very easy to look at the data and say, okay, this is working or it's not, right? For larger sales cycles, maybe I'm selling upper mid-market enterprise where the sale might take 9 months, 12 months, in some cases 18, 24 months. You can't roll out a comp plan and not see behavior for 6 days and go, well, this isn't working, we're not closing deals, right? So what we tell companies to look at is look at the activity, right? So the reps that are closing, 5, 6 deals in a year to hit their quota, are they building pipeline, right? Do they have leads coming in? Have they progressed that pipeline to certain stages? Are they having the right conversations with the right people at the company, right? And so you do want companies to give the compensation plan a chance before throwing the baby out with the bathwater and saying, hey, we rolled this out in January, we're not seeing progress in May. I'd say set clear KPIs and metrics at the beginning of the year to understand, are we driving the right activity? Do we see the performance? Do we see the momentum? And if not, start to make changes, but don't just assume because you're not seeing them quickly, especially for longer sales cycles, that it's not working yet.
Mm-hmm. Yeah, I have seen companies that get frustrated and every 3 months are saying, let's do a spiff. And do you have any opinions on spiffs or special programs associated with the comp plans?
Yeah, so spiffs are there's a time and place for spiffs. Spiffs, we say, should never exceed 10% of someone's target incentive because then it dilutes it, right? I've been in companies where reps say, wow, my target incentive is $100,000, my variable, and I can make $50K in spiffs. Maybe I'll just focus on the spiffs and ignore the comp plan, right? So I think there's a time and place, right? You're rolling out a new product, you want to get some momentum, or you're trying to kick off Q1 effectively, or you want a little bit more buildup in Q4 and you want to get people excited. So you don't want them to supersede the comp plan. So we just caution people not to go too crazy on spiffs.
Got it. All right, so last thing on comp plans. So sometimes you see that there's a tremendous amount of thought that goes into the comp plan and the engineering of the comp plan, and then the rollout is this. Here's your comp plan, sign it. Do you have some guidelines on best practices for the rollout, how it should be done, how it should be communicated?
Absolutely, and I'll be the first to admit that I've done my fair share of poor execution of rolling out comp plans. I've also rolled out comp plans effectively, but
those are the best learning experiences.
Exactly. So I've learned what not to do. So a couple of things that we highly recommend, right? One is making sure you have full alignment from senior leadership. So this is before you get to the manager level on exactly why we're making changes and what the outcomes we want from the compensation plan, right? Are we trying to drive more new business? Is it expansion? Is it a mix of both? Are we trying to push one product versus another? Are we trying to incent for growth in a certain region, right? Whether it's Europe or the US, et cetera, or vertical. Second is make sure you've got buy-in throughout the year from key stakeholders in the company, right? As you're starting to think about the changes to make, talk to key reps, talk to key leaders to say, hey, we're thinking about doing this, what do you think, right? So you've got a little bit of buy-in early on, or you get some understanding of, hey, that's not going to drive the behavior you think, right? Third is meet with the leaders ahead of time before rolling it out. So the biggest mistake is this is a corporate compensation plan, it's being rolled out by HR or finance or operations. No, it's not, right? This is sales should be rolling out the compensation plan. So you want to make sure the leaders, right, first line managers, second line managers, the CRO, are all bought in and that they're the ones communicating it to the field. You should always obviously have operations, finance, HR, legal there to provide support, right, in case a rep has a question. But I should be hearing from my manager or the CRO on why do we make these changes, why it's good for you, here's how you can make a lot of money, here's the behaviors we're trying to drive, right? And then last is don't stop, right? So you roll out the compensation plans and then people go, cool, I'll wait until the next planning period, I'm done. No. You want to make sure you reinforce the behaviors, every quarter in QBRs, in all hands. You also want to make sure that you want to call out reps that are making a lot of money, right? You have a rep make $1 million or $700K, whatever is awesome for your company. You want people to know that, right? You want people to get excited about, I could have the potential to make a lot of money in this company, right? So you want that continual communication. And I'd say as part of the communication also, follow up with people. Is the plan working? Right? What do you think? Or maybe it's driving behavior that has unintended consequences that you really didn't think about, right? So it's continual 360-degree sort of loop on rolling it out effectively and then staying connected to it.
Great. Well, Pablo, thank you for everything,
Thanks.
your time and insights. That was a great show. Thanks for coming on.
Anytime.
All right. Thanks. And we want to thank the SBI audience for tuning in. Thank you for your continued support. As always, until next time, I wish you good luck as you try and make your number. Thanks.
This has been the SBI Podcast. For more information on the studio, SBI's Executive Briefing Center, our team, or to schedule a workshop, please visit salesbenchmarkindex.com.